if you've got a $5 million portfolio, the financial institution whose name is plastered on your favorite sports stadium might actually be the worst place to keep your money.
Yeah, that's a tough pill to swallow for a lot of people.
Right. I mean, think about that for a second. You spend decades building a business, climbing the corporate ladder, making all these sacrifices, and suddenly you look at your investable assets and realize, wow, I've crossed that 1, 3, or even $5 million threshold.
Which is a huge milestone.
It's massive.
Yeah.
And you naturally gravitate toward the big-name national brokerages, what the industry calls a wirehouse. You see their commercials, you know their logos, so you just assume you are in the absolute best hands.
Naturally. I mean, they look like the safest bet.
Exactly. But the very system you are trusting to manage your life's work was largely built for scale and volume. It was not built for the highly specific complexities of significant wealth.
No, it really wasn't. And it's a sobering realization for a lot of successful people. They essentially outgrow the financial infrastructure holding their money. But because the market just keeps moving up generally, they don't even realize the cracks are forming.
Until something goes wrong.
Right, until a major life event or, a massive tax crisis hits.
Which brings us to the mission of our deep dive today. We are exploring the architectural flaws in that volume-based model. And we're using some incredibly sharp insights from Davies Wealth Management.
Yeah, they're a fee-based fiduciary advisor down in Stuart, Florida.
Right, and they've mapped out the 7 critical differences between true private wealth management and traditional wirehouse advice. We are going to unpack how sitting in the wrong model can literally drain hundreds of thousands of dollars from your portfolio over time.
It really comes down to the mechanics how these firms operate.
So, okay, let's unpack this. Using a volume-based wirehouse for a complex high-net-worth portfolio is, well, it's like taking a finely tuned, high-performance sports car to a quick lube drive-through.
Oh, that's a perfect way to look at it.
I mean, sure, they have the wrench to change the oil.
Right.
Right. But they aren't looking at the suspension, they aren't checking the aerodynamics, and they certainly aren't calibrating the engine for the track.
No, because the quick lube model is entirely dependent on getting as many cars through the bay as possible. Volume is everything.
Exactly.
So when we look at financial advice, before we even touch on specific investment strategies, we really have to look at the legal and structural foundation of the relationship itself.
The duty and the dollars.
Right. The entire dynamic changes based on what an advisor is legally required to do and how they actually get compensated for doing it.
Let's start with that legal foundation. The terms fiduciary and suitability get thrown around a lot. I think most people just assume anyone handling their life savings is legally required to do what's best for them.
It is a completely logical assumption, but it is fundamentally incorrect in much of the financial world. Registered investment advisors, or RIAs, like the team at Davies Wealth Management, are legally bound to act as fiduciaries.
And what does that mean practically?
That legal standard dictates that their loyalty and care must run directly to you, the client. They're required by law to put your interests above their own compensation and above their firm's revenue.
Okay, and the big wirehouse brokerages, the ones with the stadium naming rights.
Well, many of them operate under a suitability standard or a slightly modified framework called regulation best interest.
Regulation best interest. Sounds nice.
It sounds great, but in practical terms, suitability means a broker can recommend a financial product that pays them a much higher commission, as long as that product isn't demonstrably inappropriate for your age and risk tolerance.
Wait, really?
Yeah, it just has to be quote-unquote suitable.
So I gotta ask, what is the actual harm there? If a broker recommends something suitable and it makes me money, isn't that inherently a good move for me?
Not necessarily. What's fascinating here is that suitable allows for hidden conflicts of interest. Optimal demands complete loyalty to your bottom line.
Okay, give me an example of that.
Think about walking into a store because you need a winter coat. A suitable recommendation is literally any coat in the building that keeps you from freezing.
Right.
So a broker operating under suitability could sell you the heaviest, most ridiculously expensive coat on the rack because it pays them a massive commission.
Even if I live in Florida and just need a light jacket.
Exactly. Even if a lighter, less expensive jacket fits your specific climate perfectly, the fiduciary is legally obligated to guide you to the jacket that fits your needs and your budget, regardless of what they get paid.
That makes so much sense, and that ties directly into the compensation structure, the second big difference.
It does. Wirehouse advisors typically earn a living through a mix of things: commissions on product sales, trails on mutual funds, and internal firm incentives to push proprietary products.
Whereas a fee-based private wealth manager charges a transparent advisory fee, usually just a flat percentage of assets under management, or a retainer,
Which entirely eliminates the hidden incentive.
because they're on the same side of the table as you.
Exactly. When an advisor is paid a flat fee based on the size of your portfolio, their only path to a raise is to grow your wealth. When they are paid by commission, their path to a raise is to sell you more expensive products.
The math on how those embedded product fees erode wealth is just staggering. Let's look at a $3 million portfolio.
Let's do it.
If there's just a 0.5% annual difference in hidden fees and internal product costs over 20 years, the compounding effect of that drag eats up over $250,000.
It's wild. $250,000 just vanishes.
Gone. And that's before we even analyze whether the investments themselves are actually performing well.
Right. That is purely the structural drag of the fee model. It's like a slow leak in a tire. You never notice it on day one or even year one.
But over a long drive.
Over a decades-long journey, it severely limits how far you can travel.
Okay, so if hidden fees are draining the portfolio on the front end, we have to talk about where the money leaks out on the back end. And that usually points straight to the IRS.
Oh, absolutely. Taxes are the biggest silent wealth killer.
Because wirehouse brokers are compensated by transaction volume, they generally just don't have the structural incentive to dig into complex tax planning, do they?
No, they really don't. At a traditional brokerage, tax planning often begins and ends with the firm mailing you a 1099 form in late January.
Leaving you to just hand it off to your CPA and hope for the best.
Exactly. But when you are dealing with high net worth portfolios, treating taxes as an afterthought is one of the most expensive mistakes you can make.
So what does a private wealth manager do differently?
True private wealth management integrates tax strategy into every single sell order, every rebalancing move, and every withdrawal.
Let's talk about the specific tripwires out there. The income-related monthly adjustment amount, or IRMAA, is a perfect example.
Yeah.
I feel like most people have no idea this exists until they get the bill.
Yeah, IRMAA is essentially a hidden tax. It's a surcharge applied to your Medicare Part B and Part D premiums if your income crosses specific thresholds.
And those thresholds for 2026 are pretty specific, right?
Very specific.
Yeah.
For 2026, those surcharges start kicking in if your modified adjusted gross income hits $106,000 for a single filer or $212,000 for a married couple.
Meaning, if your advisor isn't actively monitoring your tax brackets in December, they might execute just a routine portfolio rebalance that triggers a capital gain.
Right.
And that gain pushes your income just $10 over the IRMAA limit, and suddenly your Medicare premiums jump significantly for the entire year.
Over $10, it's a cliff. A proactive wealth manager is managing your income precisely to stay just below those cliffs.
And they're looking at the whole board.
Yes. They're also coordinating things like Roth conversion ladders.
Which is the process of moving pre-tax money from traditional IRAs into Roth accounts during years when your income is temporarily lower.
Right, maybe right after you retire, but before you start claiming Social Security. You pay the tax at a lower rate now, and the money grows completely tax-free forever.
Another powerful mechanism I want to bring up is the Qualified Charitable Distribution, or QCD.
Oh, QCDs are fantastic.
For anyone who hasn't hit age 73 yet, you might not be thinking about required minimum distributions, or RMDs. But the government eventually forces you to pull money out of your pre-tax retirement accounts, whether you need the cash or not.
And that withdrawal gets stacked right on top of your other income, pushing your tax bracket higher.
So how does the QCD help there?
Well, the QCD is an elegant solution to that exact problem. If you are 70 and a half or older, the tax code allows you to transfer up to $108,000 directly from your IRA to a qualified charity.
Bypassing your bank account entirely.
Exactly. By bypassing your personal bank account, that money fulfills your required minimum distribution, but it never shows up on your tax return as adjusted gross income.
That's huge. You satisfy the IRS, you support a cause you care about, and you keep your taxable income artificially low.
But here's the catch. You simply can't buy a QCD off a product shelf.
Right.
It requires an advisor who sits down, maps out your entire financial ecosystem, and actually communicates with your CPA throughout the year.
Here's where it gets really interesting to me. If your financial advisor isn't talking to your CPA, and neither of them is talking to your estate attorney, you're essentially playing a team sport where none of your players are allowed to talk to each other.
While the opposing team, the IRS, is incredibly well coordinated.
That is a terrifying thought.
It is. And that lack of communication becomes a massive liability when we shift from income taxes to estate taxes.
Because we are currently sitting in an historically unprecedented window for wealth transfer, aren't we?
We really are. The 2026 federal estate tax exemption is roughly $13.9 million for an individual.
Wow.
And nearly $28 million for a married couple.
Meaning you can pass almost $28 million to your heirs completely free of federal estate tax right now.
Right now. But that window is closing.
Because it sunsets at the end of 2025.
It is scheduled to slam shut. Under current law, that massive exemption reverts to roughly half its current level.
Half.
Yes. So if Congress does nothing, families with estates in that $7 to $15 million range are suddenly going to wake up with massive, unexpected estate tax exposure.
So a private wealth manager is proactively building defenses today. And the mechanisms they use are just fascinating. Let's talk about spousal lifetime access trusts, or SESLATs.
SESLATs are a brilliant tool.
Basically, instead of just holding assets in your own name, you move them into an irrevocable trust for the benefit of your spouse. This removes the future growth of those assets from your taxable estate, avoiding the death tax. But because your spouse is the beneficiary, your household maintains indirect access to the funds while you are both alive.
It's a highly technical maneuver that requires careful coordination with an estate attorney. You can't just wing it.
Definitely not. And the same applies to charitable remainder trusts, or CRTs.
Yeah, let's say you built a business or you hold a massive amount of highly appreciated stock. If you sell it outright, you get absolutely crushed by capital gains taxes.
But with the CRT, you transfer that highly appreciated asset into the trust. The trust can then sell the asset completely tax-free.
Exactly. It reinvests the full untaxed proceeds and pays you an income stream for the rest of your life or for a set term of years.
And when the term ends, whatever is left goes to charity. You bypass the immediate capital gains hit, generate an income stream, and get a charitable deduction up front.
It's a win-win. You also see high net worth families utilizing dynasty trusts to shield wealth across multiple generations, avoiding the trap of the estate being taxed every single time it passes from parent to child.
And private placement life insurance too, right?
Yeah. Yes. PPLI, which acts as a tax-free wrapper for alternative investments. The defining characteristic here is that a wirehouse broker operating on a volume model simply does not have the mandate or the structural setup to initiate these complex legal architectures.
Which brings us perfectly to the fifth and sixth differences: tools and time. To actually execute these strategies, an advisor needs access to an open universe of tools, and they need the actual time to manage them.
Let's look at the tools first. When you are operating inside a big national brokerage, you are frequently limited to a curated menu of proprietary products.
It's like going to a restaurant where the chef is only allowed to use ingredients grown by the owner's cousin.
That is exactly what it's like. True private wealth management operates on open architecture. They are not captive to any single fund family.
So what are they using instead?
They utilize institutional share classes, which strip out the retail marketing fees. They build separately managed accounts tailored to your exact tax situation. And for portfolios exceeding the $5 million mark, they access the private markets.
Like private credit, private equity, real estate.
Exactly. Assets which are often completely walled off from standard retail investors.
The tool that really highlights the difference in sophistication, though, is direct indexing.
Oh, direct indexing is a game changer.
If you want exposure to the S&P 500, the easy wirehouse move is to just buy a standard index fund. But if you do that and the overall market goes up, you owe taxes on the gains.
Right. But with direct indexing, the wealth manager doesn't buy the fund. They use software to buy the actual 500 individual stocks that make up the index.
And the mechanics of that are what drive the value. Even in a roaring bull market where the S&P 500 is up, say, 20%, there will always be 80 or 100 individual companies inside that index that lost money that year.
Always.
By owning the underlying stocks, the advisor can surgically sell just the 100 losers, harvest those losses to offset your other tax liabilities, and immediately replace them with similar companies to maintain your market exposure.
You capture the exact same upside as the index fund, but you generate a massive tax write-off in the process.
And lowering overall costs is huge, too. The Davies Wealth Management piece cites Morningstar research showing that lower costs directly predict better returns.
It's just math.
Dropping all-in costs from 0.8% to 0.3% on a $5 million portfolio saves $25,000 a year, every year.
It's incredible.
Wait, I have to play devil's advocate here for a second. I drive past a massive Wirehouse building downtown every day. They sponsor major golf tournaments. They have thousands of employees. Doesn't that sheer scale translate to better security, better technology, and better resources for my money?
It's a very common assumption. But if we connect this to the bigger picture, a large marketing budget benefits the firm, not your portfolio.
So the giant logo doesn't protect my money.
Not at all. Independent RIAs deliver the exact same institutional security because they don't actually hold your money themselves. They utilize world-class third-party custodians like Schwab or Fidelity to secure the assets.
Okay. So you get the institutional safety without being trapped on a conflict-laden product shelf.
Precisely.
Yeah.
Which brings up the other side of that coin, time. The advisor-to-client ratio at these large firms is just mind-boggling.
Yeah, let's talk about that.
At many wirehouse brokerages, a single advisor is responsible for managing between 200 and 400 client relationships.
400 clients. Think about the logistical reality of that number. If an advisor has 350 clients, and there are roughly 250 working days in a year, they mathematically cannot dive deep into your estate documents.
It's impossible. They can't coordinate with your CPA. They are trapped in a reactionary loop, just trying to return phone calls and conduct superficial annual reviews.
Contrast that with the private wealth model, where an advisor typically caps their roster at 50 to 80 families.
It changes everything. When an advisor only has 60 clients, they actually have the bandwidth to monitor your concentrated stock exposure in real time.
Because the most valuable wealth management conversations are the ones the advisor initiates, not the ones you have to demand.
Exactly. That capacity shifts the entire relationship from investment-only advice to comprehensive financial life management.
And life management gets incredibly complex depending on your profession. Take corporate executives dealing with restricted stock units, or RSUs.
Yeah, RSUs are tricky.
When those shares vest, they are taxed as ordinary income. A lot of executives just hold on to the stock because they believe in the company, but suddenly they have a massive double concentration risk. Their salary and a huge chunk of their net worth are tied to a single corporate entity.
A private wealth manager steps in and builds a systematic divestment plan for that. They schedule sales of the RSUs immediately upon vesting to capture the cash, setting aside the exact amount needed for the tax bill and reallocating the rest to diversify the portfolio.
And they do the same thing for business owners. If you are an entrepreneur nearing a liquidity event like selling your company, the wealth manager is working years in advance to structure the sale.
Utilizing trusts and tax codes to ensure the IRS doesn't consume the premium you built.
They also provide something that feels intangible until everything hits the fan: behavioral coaching. Vanguard has this fascinating body of research called Advisors Alpha.
I love that study.
They found that behavioral coaching during market volatility can add approximately 1.5% in net returns to a portfolio annually.
Behavioral coaching isn't just generic cheerleading. It functions like a circuit breaker in a house. Human instinct tells us to panic and sell everything when the market drops 20%.
And to buy aggressively at the top of a bubble because of FOMO.
Right. When the market spikes and shorts out your emotional reasoning, the advisor trips the breaker before your portfolio burns down. They enforce the disciplined strategy you agreed upon when you were calm.
So who is the ideal candidate for this level of infrastructure? The Davies piece highlights executives with complex deferred comp, business owners planning an exit, professional athletes, entertainers, and retirees with over $3 million.
It ultimately comes down to your tax exposure. IRS data clearly shows that taxpayers with incomes over $500,000 face average effective federal tax rates exceeding 25%.
A quarter of your income.
Yes. When the government is systematically taking a quarter of every dollar you generate, advanced tax strategy isn't a luxury upgrade. It is a six-figure annual necessity.
I imagine some of you listening are thinking, but my Wirehouse advisor has got me great returns. I open my app, the market is up, my balance is higher. How do you evaluate an advisor when the stock market is just generally doing really well?
A rising tide masks a lot of structural leaks. Almost any basic static allocation will show positive returns when the entire market is booming.
Sure.
But capturing positive returns is not the same thing as receiving comprehensive wealth advice. Your account balance might be up 15%, But are you paying unnecessary short-term capital gains on that growth? Are you completely exposed to the 2025 estate tax sunset?
The app looks great today, but the foundation holding that wealth might be incredibly fragile.
Exactly. And that leads us to the biggest psychological hurdle preventing people from upgrading their financial infrastructure.
The myth that switching is hard. People stay put out of sheer inertia.
Inertia is arguably the most expensive force in finance. The reality of moving accounts is completely mundane. The industry uses an automated protocol called an ACIT transfer.
And how long does that take?
It takes about 2 to 3 weeks. You don't have to liquidate your portfolio. The assets simply transfer in kind from one custodian to another. It doesn't trigger a massive taxable event. You just sign the paperwork, and the transfer happens in the background.
So the real cost isn't the paperwork. It's the opportunity cost of staying.
Every year you stay in the volume-based model is another year of missed tax loss harvesting, missed Roth conversion windows, and uncoordinated estate planning.
Blurring the whole picture into focus. Comprehensive private wealth management isn't a luxury. It is necessary financial infrastructure.
If we look back at Vanguard's research on the holistic value of an advisor, combining the tax strategy, the estate coordination, the lower internal costs, and that behavioral circuit breaker, they estimate a comprehensive wealth manager provides a 2-3% net annual benefit.
On a $3 million portfolio, just a 1% net improvement equates to $30,000 a year. It is an investment that consistently pays for itself.
Absolutely.
So it's time for a moment of self-evaluation. Look at your current financial relationship and ask yourself, has your advisor proactively called you this year to map out a Roth conversion strategy? Have they calculated your proximity to the IRMA surcharges?
Have they asked to review your trust documents ahead of the 2025 tax sunset?
Right. Or do they only call when the market corrects or when they have a new proprietary fund to pitch?
If you are the one constantly driving the planning conversations or asking the complex tax questions, you are not receiving private wealth management. You are just renting space on a brokerage platform.
I want to leave you with one final thought to mull over, building on everything we've dissected today. We spend so much time optimizing what happens to our wealth while we are alive. But if your current volume-driven advisor doesn't have the time or the structural mandate to deeply understand your tax situation and your estate plan today, what happens when it is time for your wealth to pass to the next generation?
That's a heavy question.
Will your heirs be left navigating a complex financial inheritance with a stranger who only really knows how to sell them mutual funds?
Because the legacy you leave behind isn't just the capital. It is the advisory team you leave in place to guide your family through the transition.
Don't leave your family pulling a complex machine into a quick lube drive-through. Take the time to ensure your financial infrastructure actually matches the wealth you've worked so incredibly hard to build. Thanks for joining us on this deep dive, and we'll catch you on the next one.